I'm Brendan Cremen. Used to work in UCD, still doing some work there. And I'm here just to moderate. Mostly I want these guys to talk and also you. So if you have any questions, please be preparing them because we would like to invite you to join us in discussing what we're about to discuss today. So to start, I'm not going to talk too much. To start, I'd like each of the panel members to give a brief introduction of themselves, maybe put it in the context of the discussion that we're about to have. So with that, I'll start straight away with Alan.
Good morning. My name's Alan Phelan. I'm CEO of SourceDogg, but I'm also involved in two other technology companies. So my background was originally engineering, graduated from Galway, lived in the UK for a good few years. Prior to coming back to Ireland, myself and my business partner, we grew a technology company in the UK, which we sold for a bit over 20 million. Moved back to Ireland and then decided, what do I do next? Started looking at the technology landscape. And since then, I've been involved in three companies. I run a software company, and I'm also a shareholder in a waste-to-energy company, which we spun out of NUIG, and a telecoms company we've based in the UK. So that's what I've been doing for the last few years.
Thanks, Alan. Fergal?
Hi, my name is Fergal O'Brien. I'm co-founder of Sugacoll Technologies, but as my day job, I'm Professor of Bioengineering and Regenerative Medicine in the Royal College of Surgeons. I'm a graduate from Trinity in Mechanical Engineering, and after that I did a PhD in the area of bioengineering before moving to the US as a Fulbright Scholar, where I got involved in the area of regenerative medicine and advanced biomaterials. And I returned to Ireland in 2003 as one of the initial recipients of the SFI President of Ireland Young Researcher Award, and that allowed me to establish my own lab in the College of Surgeons. And it was from that lab a few years ago that we spun out Sugacoll Technologies. And Sugacoll now has one technology, a bone graft substitute, which is a natural-based biomaterial, which has a regulatory approval and is in patients. And a second technology for cartilage repair is about to enter human clinical trials with hopefully regulatory approval coming in the coming months. And since really, I'm currently chairman of the scientific and advisory board of the company, and as well as that, I'm heavily involved with the Amber Centre, which is really developing next generation material science solutions in partnership with industry. So it's housed in Trinity College, but RCSI are a major partner in that. And a lot of my other work at the moment is focused on advanced drug delivery systems.
Thanks, Fergal. Mark?
Good morning, everyone. My name is Mark Felix, and I work as an investment manager for Dow's Corporate Venture Capital Group. I'm based in Switzerland, having graduated from University College London, and I've had a 30-year career in Dow in various sectors, from R&D through to commercial roles. Before I have to lose this, excuse me. It's probably more interesting to tell you a bit more about what Dow Corporate Venture Capital does and what's of interest to us than it is about me. So Dow's Corporate Venture Capital Group has been active as an investor since 1993, which probably makes Dow one of the earliest and longest surviving corporate venture capital groups. We've continued to invest through the period, the good times and the bad times, through the boom and bust, coming up to 2000 and 2008 as well. In terms of what we do and what sectors we look at, Dow Chemical, as you probably know, has just completed the merger with DuPont and is subsequently going to spin out into three companies. So there's a lot of uncertainty about where everything's going to end up at the moment. But nevertheless, what I'd say in the last 5 years, we've focused on four sectors, which is ag sciences, particularly in seeds and trade development, in water and wastewater treatment, electronic materials, particularly in display technologies, and the fourth sector has been in performance packaging and smart packaging. In terms of the stage of investment, there are probably as many flavors of corporate venture capital and how they go and what their rationale is. Our rationale for participation in this industry is that we think we can add value to the investments that we do through our access to markets and science and technology. So we tend to look at some of the earlier stage companies, seed stage, stage A, stage B is the kind of areas that we think we can add the most value to those enterprises. Ticket sizes can go from anywhere from $500,000 up to 25 million in a single entity in multiple rounds, of course. And I think that's an overview of what we do. Percentage of equity, we have to stick to below 20% to make sure that we meet the reporting requirements. And a couple of the recent investments that we've done in Europe have been in an ag sector company, and latterly in a couple of companies in the water industry, one in Ireland actually and one in Belgium.
Okay. Hi everyone, my name is John O'Sullivan. I'm a partner with Act Venture Capital. So we're an indigenous VC firm based here. We invest here and in the UK, and we invest primarily for companies expanding out of Ireland. Stage-wise, which is the way VCs normally describe themselves, we invest everything from seed and early stage all the way through probably classically to Series B, writing tickets from about 200K up to about 10 million across those journeys. Sector-wise, we have a very broad definition of technology. Technology has become very wrapped around the word internet. But historically, we would have done everything from material science through to semiconductors, med tech, enterprise software, moving towards consumer software, and then on to internet and mobile technologies. So we still see the world through those broad set of lenses because the deepest needs are still in those buckets. The world hasn't fully evolved to a consumer internet world yet. We're pretty active. We've probably done 100 deals in the last 10 years. So we have a regular flow of entry points into new companies and the exit horizon. What companies tend to look like for us, and it's very reflective of what successful SMEs look like in Ireland, is we sort of have a journey with companies from 0 revenues up to about 30 million. And from the first 2 people, as Chris referred to, that first 2 or 3 people stage, which is the real point we can engage with teams, up to about 150, 200. So that's the kind of what the organizations look like over time.
Thanks very much, John. So as you can see, we have a panel that has different investment scenarios, VCs, corporate VCs, and then we have, well, I think Alan probably sits on both sides of the fence, both investing and being involved in the companies themselves on an active basis, and then Fergal starting up his own company. I particularly want to recognize the presence of Mark with corporate VC. I think this is one of the first times at a KTI event that we've had a corporate VC entity up on the panel. I think that is important, and it probably is reflective, I would hope, of a maturing situation in Ireland where the corporate VCs are starting to get involved and looking at our companies more and more. And Mark did reference the UCD spin-out that Dow have invested in the last few years. So we are seeing a maturing of the industry, and I think that is a positive reflection on what's happening, and it echoes a little bit of what Chris was saying earlier. So I'm going to start with some questions. Again, I am going to ask the audience for some questions as we get towards the second half of this. So be thinking about them as you're hearing your answers or hearing the discussion, and you have something that you want to ask, you will get the opportunity to do so. And I'm going to start actually with Mark because it is a new area for us to discuss. In financing a venture, and you briefly touched on it, but maybe you can go into it a little bit more, what would you be looking at, and perhaps what would be the differences as to how you look at something versus a VC would look at it, in terms of timelines, motivation, time, all those kinds of things? Sure.
Let me preface my comments by saying that I can only really represent the views of Dow's corporate VC group. DuPont's got its own organization. As I said, I think there are as many flavors of rationales for participation in corporate VC as there are corporate VC groups. There have been close to, I think, 1,000 corporate VC groups start up in the last 5 years, which is, a huge increase in the number of corporate VCs. And they've all got a slightly different rationale. But I think nearly all of them have a sense that this is about innovation and developing new technologies and accessing new technologies. So I think that's the fundamental difference between what us as a corporate VC looks at for companies as conventional financial VCs. So our financial returns on our investments are necessary, absolutely necessary, but it's not sufficient. What we as Dow look for is that strategic alignment with a Dow business. So if you said, what's the most important things when we're looking at investment? First, Chris already touched on it, you've got to have a team who's committed to you've got to have a defensible technology with as big a moat as possible from your competitors. You need to have an attractive market. And the fourth thing that I would overlay on that from a corporate perspective is it's got to be something that a Dow business cares about. Otherwise, it's going to be very hard for us to invest without that commitment from a business and a sense that this is something that can add some tangible value and tangible business benefit to the corporation.
And in terms of timelines, again, Chris mentioned the classic VC, 5-10 years. Do you have a timeline, where you expect to get a return?
So we operate off our balance sheet, so we don't have a fund. So we don't have an investment period and a return period. Having said that, I think, again, I'll can only speak for Dow, you may see us as patient capital, but we have other things that we bring with us, other baggage that corporate VCs bring with us, which have their own nuances about whether it's attractive to an entrepreneur or not. I think we're patient to the point of it continues to make strategic sense. But bear in mind that when you're talking about corporate VCs who operate off their balance sheet, with a 1 million and 5 million investment, that can be written off fairly easily. So when it reaches a point where you say, look, this is not adding any strategic benefit to me, I think corporate VCs are probably as ruthless as anyone in turning off the tap.
Okay. And turning to John, just to follow up on that strategic, there's more and more scenarios now where VCs, regular VCs and corporate VCs are starting to work together. How does a regular VC look at that strategic element of the investment compared to the pure return when you're working with a corporate?
Yeah, as a lot of things with VCs and startups, the generalizations are dangerous, but here we go. So we've been doing tech venture, I've been doing it for about 20 years. So, and the firm has been doing it about the same. So we have a pretty reasonable data set now on at least what our world looks like across a lot of transactions. So we have a lot of US co-investment, strategic, and VC. So I say it from a benefit, I could give you a long list of names, but Mark's hit the nail on the head. The word strategic and corporate, you got to be very careful of because they're not all strategic. So that number that Mark gave you of 1,000 businesses making it, and these are large businesses, making a decision to have a VC firm in the last 5 years. Hold that number in your head. Now, what does that tell you? They can't all be strategic. They can't all be that deeply strategic in that time frame. So Dow is to be fair to Mark, he's been very, very magnanimous. Dow have been doing it for 30 plus years. So it is deeply ingrained in their culture, all the way up and down the organization, how they do it. Now, both teams use the same word. We are strategic investors. Now, telling what each party means from that is a bit of fun. And so what's happened in VC is essentially the strategics, the really, really good strategics, have been using their money to send signals into the marketplace to leverage up the money into the companies for certain goals. There was a period in VC, if you go back when we had the last spike in corporate venture about 10 or 12 years ago, where VCs overreacted to those signals, and a lot of them were false because the corporates themselves hadn't worked it out, and there was a big washout. So it's very cyclical. It's more cyclical than VC, actually, because they tend to get in at the tail of a VC cycle, so they're the last lump in. So what's happened is VC has matured in dealing with corporates, and we see it in our own portfolio. We spend a lot of time thinking as much as we can. Now we all want the money. So if we start with that one, about what strategic means when they use that word, and to what extent will our goals be symmetrical, and under what circumstances? And if they were to diverge, what would happen? And the real test, and I'm going to go on a bit because it's probably on a lot of people's minds, and Brendan's right to bring it up, the kind of real test for this is the newest strategics have the most complex legals because they want to cater for every situation in terms of what they would do. And the most mature strategics have the simplest but toughest legals because there's only three things that matter. And then you'll know who you're dealing with in the room. And this is incredibly difficult for the VC community and the founders to work with together to filter for. Because if you get it wrong, it can be terminal. You end up with someone with a big part of your cap table who it was all very strategic for a brief period, and they get something as simple as a CEO change, and suddenly it's not strategic anymore. If they don't have a mechanism internally to deal with how they're going to work with you, you are going to be explaining that and dealing with that for a very long time. And so there's this huge benefit, but then you owe yourself the diligence to figure out, right, what happens if? And trying to bring the two of those together is something we spend a lot of time with the CEOs with in terms of, okay, what does this really mean and how would it play out?
And just to, I want to go on to the other two lads in this context in a minute now, but just for the two of you, your time of engaging with companies, you know, the regular VC versus the corporate VC on their path? Your timeline would be fairly early, I presume, in your case.
In terms of when we want to get involved, well, we're seed Series A investor ideally, so for us it's quite that early. But to be fair to corporates, we see them right across the range. And if I segment out all the newbies, people who do it for marketing purposes, to people who thought about it, they're up and down the range as well, because they're operating this. If their teams are working correctly, they're operating a strategic radar, and they're the ones deciding what's mature or not, because they're not looking at the revenue line. They're looking at something else. And so you can see them up and down the stack, which is what makes working with them quite exciting, if it all lines up.
In your case with Dow, do you early, late, middle?
I'd say, as I said before, I think we focus on the earlier stage because our strategic rationale is that we think we can add value to the company through some sort of collaboration, and you know, and so that really, when you're looking for growth capital, expansion capital, you know, whether the money comes from us or from you or from a corporate VC or financial VC, doesn't really matter because you're looking for growth capital at that point. So where we think we can add value is really in those early stages. So I'd say we look at Series A, B, probably more than in the other stages.
Thanks. So for the two lads who have actual companies in play, engaging with a corporate, whether it be through a VC arm or the corporation itself as an investor/partner, do you have any comments on the, so, you know, the advantages? That'll start with Alan, or the disadvantages, challenges with that?
Well, our current companies we funded ourselves from our previous business. I suppose when you start aligning with a corporate for investment, I suppose one of the things we found along the journey is corporate VCs, like in the end, they buy out a very small amount of the companies that they invest in. You know, so they're investing from a corporate point of view because they see some kind of strategic alignment, but that alignment may not pan out. I suppose the fear factor from a company when you take corporate VC money is whether that causes any issues down the line when you eventually maybe sell the business or are about to sell the business, because you always, as a company, have the thoughts that, well, why isn't the corporate VC buying you out, or why are they not following their money, or why aren't they doing something? So, so I suppose that's the fear factor from a company point of view.
Fergal, do you have any experience in this space?
When we were trying to bring out technology, the challenge in our area, because we're working in implantable medical technologies, is I thought it was fascinating to hear Chris talk about taking something all the way to IPO in that length of time. The challenge we have is that we need to put that through trials, a series of different trials, because of the strict regulatory challenges that are in place in order before technology can be put into humans. So when many of the VCs we spoke to in the early days would have said to us, really exciting technology, really, really great science, but come back to us when you're a little bit further along the line. And many of the VCs we spoke to said that at the stage. And we've been fortunate that there was a number of private investors have stayed with Sugacoll all throughout the path to bring the first technology into clinical, into humans, into patients, and so on like that. I think for a medical technology like that, you really need to have some real good seed fund available. And I think when Chris mentioned the Atlantic Bridge Seed Capital Fund, I think funds like that could be absolutely invaluable for a university-type spin-out that's trying to grow to the next stage.
Thank you. Switching a little bit now to managing and choosing an investor, which is a huge challenge for any startup. So again, at this time now, I'll start with you two. We'll start with you, Alan, first. You know, what should a venture be aware of, watchful for, when choosing, engaging, developing a relationship with an investor?
Well, I think when you're starting out in the business, you think it's going to be easy. You know, often people think it's going to be quick, and it never is. You know, I mean, I suppose in my experience, and I've been involved in a number of companies, it's always taken me kind of 5 to 7 years to get a product to a point where it's about to, you know, ready to scale. And scale to me is when you're fit to take on, you know, a decent number of decent-sized customers and go faster and faster and faster. So if you think that, and every time I've done it, I've thought this is going to be easier, and it never has been. So if you think you've got a 5 to 7 year journey before you're fit to scale, you have to fund that 5 to 7 year journey. And I suppose, again, in my experience, you're looking 5 million to get a company to that scale position, and maybe more in medtech. I'm not in medtech, but so you need to think of that journey of how am I going to get 5 million to get me to a position where I'm out of the valley of death, and that's a cliche term, but the valley of death is, and you see this a lot in Ireland, is seed capital has become more readily available. I'm definitely not saying it's easy, but it's more readily available. Scaling capital is there in the market. So scaling capital is when you have a product, you have customers, you have bite, you can see that this is, put gas in the tank and this will go fast. The bit in the middle is the tough bit. So the bit in the middle is when you're there sweating the long nights and hopping on a plane yourself and out there trying to sell the products, and you need to keep the payroll paid and all that kind of stuff. So, getting to your first, few million in revenue is the tough bit. When you have a really proven product and it's obvious that the thing is going to scale, you'll have people knocking on your door rather than you knocking on their doors. And in Ireland, I think the bit in the middle is very tough.
Fergal, in your experience dealing with investors, do you have examples of challenges that you met and in choosing them and in dealing with them?
Absolutely. I think when you're at the stage when you're looking to spin out, there's a kind of a feeling somebody's has money on the table, let's jump and run with them immediately. But I think, especially in the med tech area, it's really important to look at the track record of the investors and what they've done in the past and do they understand the space. And I give you the best example of that is the regulatory environment. We're in a state of development and flux in medical device technology, where the guidelines that the FDA and the guidelines that the European Medicines Agency, they're shifting all the time. So as we began to move forward with a technology, suddenly the regulatory landscape changed and required that we would now need to do an extra animal trial before that technology would be able to get approval. Now, straight away, that shifts everything in terms of your original business plan, in terms of when you proposed that you were going to go into market entry, when you proposed that technology would beginning to be generating revenue. And again, we were fortunate that we had investors on board that understood that and understood that some of these issues that had arisen were completely outside of our control and stuck with us and stuck with us for another stage of funding so that we could bring that and carry out the extra study that needed to be done and eventually get to success, and success being when it's regulatory approved, while all the time we're trying to grow the concept of the technology with our marketing plan and reach out to clinicians worldwide.
So that's the company point of view on that. As investors, what do's and don'ts in terms of choosing partners for the companies now from their perspective? John, do you want to start on that?
Yeah, I guess there's a couple of things to touch on, and without sounding too vague. The first one isn't vague, is you got to make sure they have the money. And that sounds a bit trite, but actually really have the money against all those what-ifs that could happen. Because it's one thing investors being very understanding when the things change. The question is, that's very nice because it means you have a nice coffee, they nod, and they were very understanding. Really what it means is they were very understanding and they wrote another check. That's the true definition of understanding. Now, you can be understanding as you like, but if you don't have a check to write, it's going to completely adapt your view as to what strategically the next options are for the company. So now someone is sitting at the table with you who's very understanding, but they're filtering everything you're saying by, can I write a check, can't I write a check? So it isn't like all strategic options are on the table. There's a whole set of strategic options that are now off the table and can't even be discussed in a what-if scenario. And so that tri-comment opens up the door to lots of other stuff. We could spend days on it.
I should add there, I agree with you, that definition of understanding.
Yeah, exactly. Because it's pretty hard. The other one's pretty tough. But, this is going to sound like truisms, and they're truisms because it turns out over time they're true. The standing one is if you do not think that person on the other side of the table, and it's a two-way street, respects you, and it's really hard to get your radar on that over time, then you're probably in the wrong room. Now, you've got to ask yourself the question, well, if they've got the money and they're the only one who's got the money, then you've got to ask yourself the question, well, how do I generate a relationship in a short period of time that lets me understand that we can build that relationship of respect over time? Because it is going to go on for 5 or 7 years. It is going to go up and down. The second thing is a little bit more, and they play against each other. So the third thing is how do they deal with new information? How do they process information? It's going to sound a bit touchy-feely. How do they react to information? Are they high oscillation, low oscillation? Because you really don't want your investor to be in high oscillation, low oscillation, because you have enough role as a CEO and a founder because your whole world is high oscillation, low oscillation. The last thing you want to do is an investor who amplifies that on the reaction to the latest bit of information. So their ability to stand back, aggregate large amount of information, come up with reasonable conclusions. And the only way they can do that is if they make reasonable attempts to be in your marketplace and understanding over time. So those 3 points filter down into lots of different things. But if you can build a view that those 3 things are on the table, then you're probably one of the right people.
Okay, good. Do you have anything to add, Chris, in this from your perspective?
I think there's an element of self-reflection that also needs to happen on the part of the entrepreneur. I think you need to understand, try your best to understand the motivations and the rationales for the investment syndicate that you're looking at. Why are they investing? What do they want to do? What do they want to achieve out of this investment? But I think you also need to reflect on what you want from an investor as well. Is it just cash? Is it advice? Is it, are there other elements? Are there access to markets? Are there capabilities that you want to access from an investor? Understand those and be very articulate and clear about those, because when the first interactions happen, everyone's happy, clappy, and we can do this for you and we can do that for you. But unless you nail it down in some form of agreement, it may not happen. And then everyone's going to be disappointed. So be very clear about what your expectations are. Be very clear about, do you see a corporate investor as your eventual exit? That is going to color that relationship. So, and there's no point hiding that and pretending that it isn't, if that's what you really truly believe. So, I think there's an element of really understanding yourself and what you want out of that relationship as well in terms of, choosing your investors.
I think, to use John's term, a truism, there's no doubt that probably the most important, one of the more important elements of the team that Chris was referencing that has to be built up is self-awareness is critical to any success. You have to know your abilities, but also your shortcomings in lots of different areas in order to succeed, no doubt about it. Another area that comes up as this system in Ireland matures is legacy issues that might have occurred in early stage investments that might cause problems later on. We're starting to hear more about these things, which is positive in the sense that investments are now coming in at more and more stages. But we need to learn from them. Again, I'll start now with the investors, this time going back that way. Things that you've seen later after the first stage investment that have caused problems as you've looked at a potential investee.
God, I could come up with long lists, and each case is specific. So maybe I just wind back to the starting, if you don't mind, to the starting premise of the question. You're right, there is a lot of discussion of this at the moment. The difficulty with the discussion is it's encouraging in debate, because I've been to a lot of meetings in the last year where people want the perfect list of all the things they shouldn't do, so they can get all that absolutely nailed down, and it actually begins to consume them. Well, if I do this, then that will happen, I can't do that, and they are wrapping themselves up in chains right from the get-go. What investors are really investing in, and it's going to sound incredibly simplistic, is the market opportunity and the team. And for us, it's in that order. Now, if the investors, the new investors, think those two things are exciting enough, it's amazing what issues they'll get over. Now, and that's really important to hold that, because that's, people's propensity to negotiate and work with people is a function of how exciting those two things are. Now, to go back to the things that you should never do. So the most difficult one that you come in, and it's the most emotional subject, and I don't have a right answer, because we have to listen very carefully in how people got to the point when they arrive, is when attempting to look at what the next 3-5 years for the company might look like, and it's a broad set of scenarios, is that the equity is in the hands of the wrong people. And actually too early in this, and the word company is a terrible word, these aren't companies, they're projects. And they're not big projects. Think commando type project versus infantry type project. These are very special things at very special points in their lives. And using company language can sometimes occlude how the nature of what's going on. So you can have situations, and the one we're most concerned about is where actually the people who are on the front end of the commando force, which is the people with the highest propensity for risk, actually their reward structure looks like they're highly paid employees if it all works out. And if there's any sense in our heads that that's really disconnected, we absolutely know that down the line there's a bomb in the basement, to continue the military analogy. That is going to come up pretty quickly because they're going to figure that out. And that asymmetry just builds and builds and builds over time. Now, we've been in situations where we try to correct it, and it's very emotional. And we've tried to correct it and got kicked out of deals because we tried to correct it. And lo and behold, the next guy did the deal, and because people have been over the emotion of the correction, that's what was done. But that's the one where I'd say, There's a lot of talk about issues around IP, who has what. I think that's posturing for internal negotiations, but that's the real one, is who's got the incentives.
The classic cap table issue. Yeah. Mark, from your point of view?
Yeah, I mean, I think I would echo that. Try and keep your early investors aware of the fact that they either have to follow their money or they're going to have a change in their relationship with the enterprise going forward. The people who come in with the big bucks later in the stage will pay the piper and control the game. So I think the early investors have to recognize that. I think for early companies, I'd say be realistic in your valuation expectations, because if you oversell, go out to high valuation, you may be able to track the money, but you'll have a down round and things will get painful later. So, be realistic in what you expect and keep it simple as much as you can. Preference rights and things you can't avoid, but don't make it too complex.
Have either of you experienced any scenarios there in terms of early investors and what happens afterwards?
Yeah, well, I think one of the things that you see sometimes in Ireland is, you have to be a little bit careful about friends and family investment and angel investment in Ireland, I think, because, what I've seen here is angel investors at a very small level, like 50 grand angel investors. And they're kind of painful to manage because at some stage, they're going to be diluted down quite a lot. They're probably not strategic. And you may need to get them out later. So I suppose any investor coming in at a small level, think about, well, what is the journey for them along the way? What are they going to get out of it, and how are you going to manage that later? Because if you've got a cap table that's got, your uncle, 5 angel investors, a whole stack of people, it's going to scare other people down the line because they have to deal with all those people and get their signatures and all of that. I think in the UK and in other countries, you see angel investors coming in at $500,000 or something like that, and that's more palatable, or a few hundred grand. But I think be very scared of, or be very careful about taking, very small amounts of money and having a lot of small investors.
Maybe I just speak not on behalf of a company, but on behalf of the university sector. I think probably one of the great things that KTI has done over the past few years is helped to standardize the expectations within the university sector, even in the types of agreements with industry, how that's carried back out, but also in terms of equity stakes in companies. Because I think if you looked at the Irish landscape 10 or 15 years ago, many of the universities had unrealistic expectations of how much equity they should have in a spin-out as it's begun to evolve. And that's changed. I think there's a far deeper understanding that's begun to evolve with the Irish university sector over the few years. But KTI has really helped to standardize that across the system.
And that's a great segue into the last bit that I want to deal with, and then I want to open it up to you, so be preparing your questions. And that is around the relative value of that early stage engagement with the university. So the university, you're spun out. We're in the context today of university spin-outs for the most part. The university spun it out. It has taken its equity. The journey is quite long after that. So what needs to be added, and how long does it take to go from that university spin-out in order to get to some level of scaling? I'll start with you, Alan, because you've done it a few times.
Yeah, well, we've we successfully spun one company out of university, and we've spun some other technologies out of universities that have kind of fizzled and died. I suppose our experience is that, spinning a technology out of university, it probably shortcut the scaling timescale, as in from spinning it out to being fit to scale, instead of taking 5 to 7 years, took us 3 to 4 years. And that's because we were working in parallel with the university team pre-spin-out. I suppose spinning a technology out of university, it complicates things a bit because you have obviously another party in there, but it does de-risk it because you've done a lot of work putting a lot of money into the company. So certainly we found it been a positive experience, particularly with Galway University. But it's not uncomplicated, and I suppose sometimes the universities probably need to understand the flip side of this, which is, the company we spun out, we started working with the team back in 2009, and we're now 2017. All of these things take a lot of time and a lot of energy and a lot of effort. So, but our partnership with the university has been very good, so I can't complain.
Any comment from the investor side on that topic?
We're back to the very dangerous generalizations and averaging. Maybe try and put some numbers on it. And the difficulty with, early on, Alan answered some questions, and he put time frames, 5 to 7 years, things taking longer, and we have some similar experiences. So the difficulty, what I'm going to say next is actually going to put Chris's journey in even starker contrast. He was very magnanimous about it. So if we take that step and use some of the kind of metrics that EI are looking at, that step from revenue, you have to use some metrics, so we'll have to use revenues of some form as a proxy for success. And again, averaging is dangerous. But you're talking about that step from sort of 0 to 2 million in revenues. And that is very regularly taking good companies 3 to 5 years from absolute startup. Lots of caveats around that, depending on sectors and stuff. Now, what happens after that is a subset of those companies, you can argue the better ones, certainly for the world that we live in, actually their journeys from 2 to 10 are another 4 to 5 years. And if they do really well, and it's a further subset, they actually start to get faster. And it's an extraordinary phenomenon when you start to see it in action, is that sort of 0 to 5 year journey is really about product market fit. In certain industries like medical device, it involves large upfront capital to get, and the FDA helps you decide product market fit in some respects, so sales can go faster later. In other industries, product market fit is all about engaging customers, and the customers will fund it up front, and you don't need VC, which is the way it should be for most companies. VC is only right for a certain set of situations. So that 0 to 2 million is not just about the 2 million, it's about the product market fit journey and what signals you're getting and being able to adapt to that. And that's why, if that works, that's why it goes faster. The market has fit, and the market's pulling it. And it's pulling it faster and faster if you're very good at it. It doesn't happen very often. It's quite hard to do. So these companies that you see that we all talk about as landmark companies, and Iona was one of them, whether they use the language internally at the time in Iona, product market fit, and Chris can tell us over coffee, but they absolutely had it. They had that segue of product market fit and timing. It was an extraordinary period of change in the computer business as that transition to open integrated systems began. And Iona was sitting there at the right nexus at the right time. So timing plays into this as well. But so there's those steps, what plays into it. And so people should think of these as 10-year journeys. But it's the step to 2 million is the one.
So I'm going to turn it over now, but just to summarize that, I think it's an important point that from what we've heard there, that the university spin-out occurs to get to some level of product market fit and beyond is still a long journey with a lot of the team, a lot of the fundamentals of the company still have to be built in. It doesn't start at zero, at some point already fully formed when it comes out of the university. I think there's an important lesson in there for everybody. Go ahead.
It's longer and costs more than you think.
Yeah, absolutely. And expectations around that need to always be well dealt with. So, any questions from the audience? I'll turn it over to you now if you have any questions that you wish to ask related to what we discussed already or any other topic on the broad area. David?
Don't say that.
Thank you.
If you'll introduce yourself first.
Sure. David Murphy, NUI Galway Innovations Office and Technology Transfer. So Alan, delighted to hear some of your positive comments and the experience, but to dig a little deeper into that, working with the universities and taking a technology to a project, and then the investment side taking a project into a company and an investment successfully, what do we need to do differently? What do we need to do to improve? And also if there's any positives about what we currently do that would be received well too.
So a good general question there about what the university does, what can it do better? Start with you, Anne.
Well, I think our experience with NUIG was very positive. Like we had a good engagement with NUIG, and I'm not saying there can never be improvement there. I think the work that Alison and the team have done in KTI has helped things a lot as well. I think just standardizing the expectations on both sides of the fence, from the investor point of view, from the TTO point of view, I think that's helped a lot over the last few years. I mean, I started looking at technology spin-outs in Ireland, this was 2008, and that's, you know, pre a lot of the work that's been done since. It's pre the business partner program and all those kind of positive developments. I suppose from the university point of view, and from EI point of view, it's probably, it'd be maybe a little bit of managing the metrics. You know, I think there's been a big focus on metrics of, you know, how many spin-outs and all that kind of thing. I think what's more important is how many proper companies are developed, you know, out of the technology that's developed in Ireland. And, you know, I think the figure that John quoted there of, you know, 2 million, you know, 2 million is probably not a bad yardstick to say, is that a company or not, you know? Because kind of pre that point, you're still a product in development and still, you know, still getting there. And getting to that 2 million is, you know, it's hard yards a lot of the time getting there. And then when you get there, suddenly things, like in my last company, the first 2 million was definitely the toughest, you know. And then we got to 2 million, and getting to 10 was a different journey, and then getting to 25 was a kind of different type of challenge. But 10 to 25 felt quite easy to a certain extent, you know. The first 2 was really tough. The next 10, you know, you were still hands-on, you were still managing it yourself, you're still running around all over the place. You got to 10, you could afford to have a team around you and scale it, like, but So,
Mark, I'll generalize for you, because you probably don't know the Irish situation that well, but you probably, presumably have dealt with perhaps some university companies from other jurisdictions. What would you have seen that was well done there that perhaps we could learn from?
I think one thing, you know, I work very closely with the ETH in Zurich, which is one of our strategic universities. We work very closely with several of the Russell Group universities in the UK. I think one thing I would suggest that, you know, TTO should think about is that a spin-out or a venture funded company is not necessarily the panacea for every solution. You need to think about that as one possible solution for extracting value for the university along a continuum. It could be licensing, might be the best option. It could be a collaboration, it could be a joint development agreement, but you need to present that to us, us as corporates, in a way that says, you know, there's a technology here, let's find out what the best way to extract value from this opportunity is.
Good, very good. Any comments from you there?
Two sides. Maybe one's a little bit, feels like a bit of a history lesson. Actually, refer to Chris again, because Chris has 2 major waypoints, and 3 now. His Iona time, his innovation task force when it was like a big reset here, and then his kind of commitment to the innovation and his work with ABV. So if you look at that 25-year continuum, and I was, at the time I started in the software industry as a graduate up until now as well, it would be hard for most people in this room to appreciate, Brendan would know some of it as well, the step change in that 25-year period. And you know, we could create a long list of how, if I really showed you by numbers and by people and by value of investment, it is quite extraordinary, because we live in a very small place. So our state has made a very large commitment in various forms across that ecosystem over this period, and is likely to continue. And for our size, it's quite extraordinary. And sometimes we tend not to appreciate that, and we tend to criticize the system. And I can list you the 155 things pretty easily that if I had a magic wand, I'd change, and you'd have another 155 with a big list. But you kind of got to look at that arc, that trajectory is amazing. Now, despite that, here's the slightly what-if bit, or it's going to come across as negative, and I can't find better words to say it. Despite that investment and that likely continuum, because as a society, we probably don't have a choice. And someone touched on earlier on, I think, in the earlier discussion about you go to other cities, they say the same words: innovation economy, knowledge-driven. They list the same sectors. And by the way, you should see them because they're a lot bigger and they have a lot more money. So there's other people who are at this stuff. I still wonder the extent to which, because of the institutions in which it's carried out in, that we're interfacing with, that despite this effort, we're still very early, and some people will not like what I'm going to say next, in the cultural transformation that you need deep inside universities, because they're unusual type organizations. We're on the way, but I think deep down inside them, we've still got to crack that. If it's like drilling for oil, we've really got to insert this right into that DNA. And I do wonder, are there ways to make that happen faster? And I think it needs to happen faster sooner, because the state can't keep rolling this type of open purchase order in the hope that everything will be okay in the future without somebody at some point saying, tell me how that went on. And you can't keep saying it's coming in 25 years' time, unfortunately.
The best solution for everything is culture change, no doubt about it. The toughest thing for everything is culture change. Do you have a comment, Fergal?
Something coming from both my colleagues. I think, Ireland's very new. The university sector, and SFI was only set up in the early 2000s, and EI not long before that. So Ireland's new from the university perspective. What we are now is, however, we have evolved, and like a lot of what we do in Ireland, I think the university's coined on quick. I mentioned KTI helping that process. But the likes of the big centres of excellence that we now have, the Amber Centre that I'm heavily involved in, that's giving us the opportunity to both focus on taking really world-class science and world-class technologies out of the universities, not just in terms of spin-outs, because we're working with many multinationals, with small companies as well too, to bring the technologies back out of the university sector. My only concern at the moment is we're hearing all the time about how Ireland has moved up the rankings and that we're in a really, really strong place. And my concern is that the government might start thinking that it's done, we've put the investment in, we just maintain the status quo. And now that we're breaking into all these top 10 rankings, in my area of material science, we're number 2 in the world in terms of citations, which is unbelievable. In immunology, we're similar. In nanotechnology, we're similar. But to stay there, we've heard continually about how this is a global economy, how every country is saying the same thing. And now it is absolutely critical that the investment from the government is not just maintained, but that it's actually expanded in order for us to be able to grow what we've done so well so far.
Good, very good. Any other questions from the audience? Keith?
Thanks, Brendan. Keith O'Neill from Abbott. Can I return back to the what Conor referred to earlier as the hoary old question? And that's the stage at which companies tend to be acquired or sold in Ireland. And we sort of go into this self-flagellation mode, or at least certain parts of the community go into self-flagellation mode when these companies are sold. And the inference is that they're being sold too early, that there was a lot more potential to grow, that there was that it's a lack of ambition, or for some other reason. And we jump to discussions on how can we encourage these companies, how can we put supports in place to help them, like Chris's company, to go all the way and to a public listing. I'd be interested in the panel's views, but in particular the investors' views on, is there anything wrong with these companies? Do they sell at the right time for the right reasons? Are there things that we can do to encourage them to stick around longer? Is there a problem that we need to solve at all?
Thank you. Thanks, Keith. Here you go.
Thanks, Keith. Okay. Yeah, the public debate on it is overly simplified. I probably tend to agree with your premise about, I don't think it's actually a problem to solve. It's a symptom of another problem. There just aren't enough of those companies. So if you have hundreds and hundreds of companies that have the opportunity to exit between 20 million and 50 million or 80 million. Among all those groups of market participants, some of them will choose to go on and say no. So it's a scale issue. Because in truth, if you go to any other economy that takes this seriously, they sell lots of companies, and Chris mentioned this, lots of their companies are sold below 100 million. You just don't read about them because they don't make the international press. But they have hundreds of companies. So you get these ones that break through. Now, so why do some break through and not others is the next question. And again, the debate overly simplifies that because it assumes all companies are equal, all opportunities are equal, all people are equal. Each of these situations is so dynamic in its own right. It's a function of the people's ambition, fear, and greed, if you want to put it simplistically. But it's really a function of market opportunity and their execution. Growth solves all problems. Growth provides many answers. What Chris didn't outline, and again, he was very magnanimous, is the actual raw revenue growth in addition to profitability that Iona generated within that marketplace. So it was the market leader in a market that was exploding. Now, they are the two hygiene factors if you want to have a company that goes on to be that next stage. The other misnomer that's out there is that somehow is the classic, there is an element of it, is the investors made me do it, inverted commas. Well, it was all their fault. The truth is, in most situations, it's a hugely human point. Alan will have seen it, you're probably experiencing it as well, is that it has been so hard on a deeply personal basis, emotionally, physically, to get to a point of value. That when that point of value arrives and someone is prepared to put several $1 million, many millions of dollars, on someone's kitchen table, that's actually the discussion that's going on in the room, in most cases. That's the truthful, honest discussion. And the truth is, in most cases, the management team, who've got the best information, and the founders, they've got the best data, they're running the business, they should understand this market to their fingertips. They call it.
Yeah. Very good. Chris, anything from the more international perspective?
No, I don't necessarily think that, I would echo your comments, I don't necessarily think there's necessarily a problem that with companies exiting at those kind of early, 50 to 100 million type valuations. I would wonder also whether there's also a reflection of the investor base. When you're looking at investors who've got $1 billion, several $100 million funds, they need to have exits at higher valuations to be able to return the capital to their investors. And so, in Europe, I would also wonder whether that's also a reflection of the investor base.
Very good, very good. I think we're probably, are you okay for time? Or we're winding up, okay. There's probably time for one more question. I see a couple.
There has to be more.
Sorry, is there a hand over there? Go on, you're waving, go ahead. I can't see who it is.
Good morning. Liam Lewis from Cork Institute of Technology. Just a question maybe for the panel, but to throw it out there in general. We've mentioned sort of as a catch-all term, perhaps, or generally, the university sector. What about the Institute of Technology? I think there's a lot of applied research, there's a lot of good work that's done there. Is it something that's just sort of in the culture now that we don't look at those, or is there more we can encourage to look at the work that's done there?
Do you want to comment on that, Alan?
I don't think there's I suppose when someone's looking to invest in a technology, particularly a university technology or an institute of technology, if I can say that, you're looking for something that's protectable, scalable, valuable, and that can come from any source. I don't know if there's any particular reason why universities have, more spin-outs than institute of technologies, but I suppose the type of research they're doing is potentially ending up with more technology of that type. My experience of the ITs is the people I've seen come out of ITs are very, very good. The people we've recruited from there are excellent. But I don't know if I can particularly point to why there isn't the protectable IP type technologies coming out of the ITs versus the universities. There's no particular reason, but those are the type of technologies that people will want to invest in and scale.
Okay, I think we have to leave it there. I'm being signaled here, so I'm going to turn it back to Connor and let him take it from this point.